Going live in 5, 4, 3, 2, 1.
Life is one of the heaviest beams one can try to support. It is known to go through storms that contain heavy winds and downpours. But you are built to stand and not collapse. I challenge you to grow out of your comfort zone. The biggest giant you will ever face in life is your mindset. One of the biggest things that limit us and keep us defeated is the opinion we have of ourselves. When I changed my mind, it changed my life. I didn't just survive, I bounced back better. Bounce back better. Bounce back better. Bounce back better. Bounce back better.
Hello. Happy Sunday to everybody. Hope everyone is having a great day so far. Welcome to LifeStruction with Eric. I'm your host, Eric. Today we have a guest with us, Mr. Derik Coffey. So first of all, everybody take the time to share this post out on your page so we can get some more people to chime in. Matter of fact, tag 3 people right now and tell them to chime in. Definitely we're going to have some great discussion today on investments. Just keep in mind, this is not financial advice. It's just general investment information, but you can definitely find more detailed information can be found on the web. But yeah, definitely take the time to share out right now. If you have any questions, feel free to click on in there in that comment section and drop those questions in, and we'll do our best to answer them for you as we get closer to the end. But yeah, as I stated today, we have Mr. Derik Coffey with us. And Mr. Coffey, he's a client portfolio manager at Channing Capital Management. Mr. Coffey has over 13 years of investment experience. Prior to joining the firm, he was a portfolio specialist at Herndon Capital Management, which he focused on value strategies. Prior to Herndon, Mr. Coffey was an analyst at UBS Financial Services and the manager research group responsible for due diligence on managers, primarily in the small and mid-cap space. Before that, he was an assistant vice president for M&A at New York Life Insurance and an analyst in the global M&A group at Lehman Brothers. Mr. Coffey earned his BA from Tuskegee University and a Master's of Science from Georgetown University. Love Georgetown basketball. He also earned the Chartered Financial Analyst designation. So he's very, very well educated in this field. And I'm just going to turn it over to Mr. Coffey and let him just talk to you guys about what it is that he do and basically how, if you are already into it, some things you may be doing wrong that he can just throw some suggestions to help you capsize on it. And basically, if you're just getting started out, we'll have him just chime in and tell you how to go about getting started. So once again, we thank you, Mr. Coffey, for taking time out of your busy Sunday. And I'm going to release it over to you.
Well, thank you very, very much. It's a pleasure to speak with you all. And it's a wonderful thing to speak about finance and investing and self-improvement. I think that's an important part. A couple of just office comments just to kind of get them out the way. The views expressed here are my personal views and not those of Channing Capital Management. So any comments, statements, or market overviews are my personal views. With that said, let me provide just a little bit of what I do and who I am. And so at Channing Capital, we are a small mid-cap manager. We manage money for institutional clients, so mainly pension funds, but we invest in smaller cap stocks. So those are smaller companies. And when I say small, they have a market cap valuation of in the range of, say, 500 million to up to about 5 billion. But we also have some large cap portfolios too. And most of our clients, are people who are investing in pension funds, some foundations and endowments, but mostly institutional clients. And I think the important part is for us, we serve a role in an investor's portfolio. Let me talk a little about what investing really is and why it matters, though. And I think this is going to be helpful. And it kind of affects me, too. So I'm a father and a husband. And so for me, when I manage my personal family finances, I'm the portfolio manager for my family and my other clients. And so at the end of the day, when I'm bringing up the returns, I'm showing them the statements. And so investing is not just me investing for my company, it's investing for my family to deliver our financial goals. So ultimately, what is investing? Investing is really about how to put away money that you don't need today so that you can squirrel away and make a return on it for you to consume it tomorrow. That's it. Putting away the money today so that you can consume it tomorrow and finding ways that it can generate a bigger return to make that money grow and work for you. And so with that said, there are multiple vehicles for investing. So obviously most of you guys are aware of the stuff in the stock market. So, and there's, market-oriented investments like ETFs, stocks, bonds, mutual funds, but there's also alternative investments. Many of you guys are aware of that are not correlated with the market. Probably the most direct one that everybody knows about is alternative investments. That's making real estate investments, but you also can do hedge funds. But ultimately, we're going to focus on the market-oriented stuff because that's the stuff that's probably gotten the most attention. And I think the point as an investor, the first question you have to ask yourself before you even start this whole thing are really three key questions. So first thing is, when you talk to a financial advisor at any time, they should be asking you these three questions. What's your ability to invest? What's your time horizon? And what's your ability and willingness to take risk? Those three things will help them ascertain what kind of investor you are. So let's walk through those three real quick, and then I'll get into some different investment styles, and then I'll kind of pause and kind of let Eric kind of chime in on any questions, because I've provided some very broad strokes here. Your ability to invest is your money. How much capital do you have? And when I say capital, that's disposable income. Money above the money you need to pay your rent, money above the need for you to service any kind of debt or liabilities that keep the lights on. That excess capital is your ability to invest. And so and the size of that money, the bigger that money, the more risk you can take. Number two, your time horizon. And different investments require different time horizons. And so think about this. Your retirement. If you're in your early 30s, your horizon is very long. If you're in your late 60s, your horizon is a little shorter. If you're in your early 20s, your horizon is infinite. And that horizon gives you ability to take more risk. So that's something you want to make sure you think about. And then the last thing is your willingness to take risk, your risk tolerance. Are you someone that is willing, that's happy to roll the dice when you go to a casino and take the biggest risk for the biggest return? Or are you someone that needs a little bit more safety and you'll take some risk, but you want to make sure that some of your investments are protected? Those are the three important questions that you have to ask yourself about any investment. I'm talking about any investment. And ultimately, when we get into the conversation about different types of investment vehicles, I'll go through that. But if you talk to a financial advisor, if he's not asking you those three questions, he's doing you a disservice, because the most important thing about investing is knowing yourself, knowing your risk tolerance, and knowing how far you can go. And over time, as you grow your assets, these things change. As you age, those things change. And I think the last thing is just a little bit about investment styles. So you guys probably are familiar with hearing about different types of investors that invest on the growth spectrum or the value spectrum. And then there's kind of guys that invest in both, called kind of core or blend. Value investors are unique because the best way to describe a value investor is we like to take walk down the street and you see a dirty dime on the ground. You shine it up, it's still a dime. It might have been dirty, but everybody else walked past that dime. I picked up that dime, I'm 10 cents richer than the person that walked past it. That's a value investor. And there are companies for which investors have kind of eschewed, thrown overboard, and not paid attention to what they're really worth. And a value investor is looking to find that diamond in the rough. And not just a diamond, but there's more companies just overlooked that have a lot more profitability. And over time, they can close that gap. And then there's another type of investor. This is something a little bit different for me, but it's the growth investor. These are guys that are looking out. They're visionaries. They can see something happening. So think about the investors in Coinbase, which is the exchange that's been just created for some of the cryptocurrencies. The thought process about creating a company like that would now be growing with a market that we still don't even know what the future looks like for that market. So it's growing faster than the U.S. economy. And when something's growing faster than the U.S. economy, that's what you call a growth stock. And so those are sort of some of the general things. I think last point I'll make, and this is just a little bit about the environment. I know many of you have been asking and wondering what's going on with the U.S. economy as we speak. So we came out of we're still in a recession, but we're coming out of it with a pretty decent recovery. The stock market has kind of moved ahead of the recovery. Stock markets are kind of forward-looking instruments. And so the stock market might be looking better than the actual economy, but the economy is showing signs of improving. With COVID kind of going into the rearview mirror, vaccination rate going up, people are consuming more, businesses are investing more. And I think ultimately what you're going to see is an economy that moves a little bit more to normalcy. But when you have normalcy, it introduces another issue here. And what is it? Inflation. There are supply shortages. There's some level of temporal inflation where things were so depressed and now things are picking up that those prices pick up very quickly. And so you see inflation a little bit. Number two, there's also labor shortages. In particular industries for which were really severely impacted by the COVID crisis, particularly travel, leisure, entertainment, restaurants, there's still a scarcity of labor. And so now hotels and restaurants are going to have to pay a lot more money to get some of these workers to come off and work. And that's part of the reason why you see these massive fiscal stimulus packages that are kind of being used to kind of get people kind of moving. But there's an element of debate. There's more politics here, but about whether those stimulus packages are too big because they're keeping people on the sidelines. But the idea is you need workers. And if a company's going to grow, it needs to pay people the market rate. And if people aren't coming to work, you got to pay more. And that inflation gets passed down to you as the consumer. And it gets passed down to businesses that are consumers. And so I think what you're going to see is a U.S. economy that I think is improving. You see unemployment will begin to come down. Obviously, again, we're going to see a little bit of inflation, but I think at the end of the day, I think you'll see something not quite normal, but more normal than it'll look more like 2019 than it did 2020. And I think that's a good thing. And I think the sectors where I think the best opportunities are for the market, and I'll pause here, are going to be kind of those cyclical sectors. So think industrials, areas like airlines, areas like, the housing market's been really hot. Why? Because rates have been extremely low. And I think rates are going to go up as the economy begins to improve. And if the rates go up, guess what? Banks, they make money on the interest rate spread. They lend cheap and they borrow cheap and they lend high. And they take that interest rate spread. With rates being low and possibly going up as the economy begins to improve, that sort of channels more money into an area of the banking sector that makes more money. There's another area, consumer discretionary, as consumers come back to the marketplace and spend more money. So industrial and materials, raw materials are going to be needed to fund and fuel some of the growth. And so that's kind of just a broad brush perspective. I have a very optimistic view of the U.S. economy. I think, again, the next year will be continued recovery. And I think, we'll probably see a little bit of inflation for which the Federal Reserve will have to step in and raise rates just to kind of slow down things. But that's a general view. I know I covered a lot of ground, so let me pause there and see if there's any kind of questions here.
I don't really have a question, but just listening to you and some of the things you was tapping in on, how much capital do you have, the horizon, risk tolerance, investment styles, and how much capital do you have? That, we were kind of talking before we went live, and so many individuals, they get it, they get the wrong scenario of investing because they think they need a large amount of money to start investing. And basically, I love how you put it. How much capital do you have? How much money do you have after you pay your rent and your car payment, and things of that nature, because basically it's like small increments that you can use. And, it may come up to be like $150 a month, but in time, it causes your money to grow. But so many people don't look at it that way, and one of the things for me, you said was risk tolerance. And someone had to explain that to me because, like, with me, early on, when I would see the market go down, I would be panicking, and, I had someone ask me, well, how much did you invest in? And I told them how much, and they were like, well, you haven't lost anything. you only lost some of your profit. You haven't even lost all of your profit.
Mm-hmm.
So it's no need to panic. But even if it does go into the amount that you invested, a lot of people has a misconception of, well, it's going down, I'm going to sell, but now you're losing money.
Mm-hmm.
So basically, when you talked about the risk tolerance and the capital, that kind of stood out to me because that was some things that I, learned, early on.
Mm-hmm. No, it makes sense. And the most important thing is that you don't need a lot of money. My first investment account, and I have one I'm creating for my kids. I had a brokerage account for Charles Schwab, and the new ones are even smaller than that. You can start an account for 50, just put $50 in. It doesn't cost any money to open a brokerage account. And now with the trading getting so sophisticated, the trading is free. It's not like in the past where you used to have to pay for your trades. And so with as little as $50, you can start the account. And probably you want to do a little bit more than that so you can actually invest in something. But you don't have to have that much money. $150 a month over time will ultimately put you in a good position over time to build a portfolio. And when you get big cash inflows, you can put that in. But you don't have to be limited by having big amounts of money. That's the thing. Investing now relative to the past has been democratized because now small accounts are what you see. That's why you see the Robinhood crowd and Reddit and Webull, like all these different platforms exist simply because now more investors can get in and play and participate. And now they're even splitting the shares of large companies where you can have, let's say like for example, like Netflix, which $300 a share or Apple, something like that. You don't have to buy a full share. You can buy a fractional share of it. So democratized. So you don't need a lot of money. And like I said, it doesn't take much. You can open a brokerage account at Charles Schwab for zero, and then have an automatic investment account. And then ultimately they'll invest in where I think you can invest in a mutual fund for most of the things on the Schwab platform for as little as $100 initial investment. And then you can just repeat that money coming in and invest it for you and split up the money along the way to the portfolio allocation you want. So no, you can do this now. And one last comment, and this is the really important one. The most important friend for investing is this concept called compounding, making interest on interest. And so it's better to start now, right? Because when you make that first $100 investment, and let's say after a year, you've got a $3 return, so you made 3%, you're going to now make a return on that 103. And that 103, let's say it goes up to now 106 the next year. Every year you're returning more money on your money, and that eventually accelerates and creates the generation effect. So compounding is your friend. So everyone, please look up compounding, compound interest. That's the real story around why it works.
Okay, good deal. Good deal. I love this discussion so far. I love it. So I want to throw in a question for you. So what are some things investors, new or seasoned, should avoid?
So there are a couple of things. Let's talk about one that everybody falls victim to. If a lot of people work for companies where they can participate in the 401k program, and the 401k program allows you to invest in the company stock, right, at a discount. This is the easy one. I just want people to understand this. And so that's okay. Okay, it's good to want to buy your company's stock, but you're exposed to your company by working there too. Your income stream is exposed to it. And so you're putting your retirement plan exposed to it. Now, oftentimes companies have requirements on how you should invest or how quickly you can sell those shares. My point is really diversify your portfolio away from your company. Your company can be a small portion of your portfolio, but make sure that you're already working there and you're subject to the cash flows of that business. And so if something happens to the company and the stock goes down in your retirement account, you get hit. And so I often see a lot of people have a lot of money tied up in their company stock. That's number one. And that's one that everybody does in your 401k. I mean, I did it at Lehman Brothers and got burned when the company went under. But I think the one that I think probably is most important, and it's kind of related to the first, and that is about diversification. Making sure that your portfolio, you're not putting too much risk in a few limited areas, but you're spreading it around the lower risk. I often hear a lot of guys play a theme. They'll hear something really cool in the marketplace. They'll invest in it, and they'll put most of their money in it. And when that theme, it might work, and then when it doesn't work, you lose fantastically. And so diversification is the key. And I think investors often get kind of the siren song of chasing returns and chasing great stories, but not investing. That's speculating. And so I say, really think about I think the biggest mistakes are one, concentration, and two, really not playing the fads, being thoughtful, stepping away and really asking yourself some key questions, those three questions. And how does this stock or this investment fit those three questions? And what's my time horizon for it? Just being thoughtful about it, not following a trend.
Gotcha. Okay. That totally makes sense. Totally. So basically, how do you determine what investments best suits the needs of your clients?
So that's a really important question. So it really goes back to the three questions. But let's give you some basic sort of parameters. I talked about a client. So let's take a quintessential client that's maybe our age, mid to early 40s, late 30s. Most likely has a family, most likely saving for college, but you have a house. Maybe you and your spouse work, and you need to save money. And you're starting to generate a little excess savings, but you need to kind of be conservative. You probably have the ability to invest, but you don't have unlimited ability to invest. You might have some savings from your work, from tax return, and so that person will be willing to put their portfolio. Let's say I don't know. I'll give it a good parameter. Let's say you want to put like maybe 70% of it in equities, and take some risk, and maybe have the balance that maybe that 30% in something that's a little bit more defensive that protects the value. And then obviously, as you get more money, you can take that risk higher. But for a working person, I think that's the sort of the way to think about it. The older you get and the more responsibilities you have, you need to put more money towards college and things like that. Your risk tolerance kind of goes down. So I would say it's really important to understand your where you are in life, and that's a good example. But take somebody that's much younger, like I said, in the early 20s. They have unlimited ability to take risk in a sense because they have, one, a lot of time, and two, they probably don't have a lot of money, but if they do have any excess money, they can invest it at a little bit more risky level, and that time will allow them to make it back. And they can be a little more cavalier. They can go 80-90% equities and be happy with that and have zero allocated in conservative stocks. It just depends. But then the last one is like your grandmother. Your grandmother, who's probably going to be living off that retirement money, wants it to be invested in fixed income. She doesn't want the volatility of the stock market. She might need a little bit to beat inflation, but she probably wants something that's going to give her dividend income and interest income. And so that's going to be your portfolio. So those are those three questions that kind of determine who you are and how much you need and where you are in your lifestyle and what your sort of real needs are.
Okay. Good deal. Good deal. So what is a good starting point for a new investor?
So, if you want to invest in the stock market, I think there are two ways to do it. I mean, I would start first with anyone that's kind of a complete novice, like you know nothing. I would say go to one of the brokerage houses. You can go to Charles Schwab, you can go to Fidelity, you can go to Merrill Lynch, you can go to Citi, what is it now? Not Citi, is it Citibank or Smith Barney, whatever, with Morgan Stanley it's now, no more Smith Barney. It shows my age, right? And a broker, a financial advisor will sit you down and ask you these questions and determine what a good portfolio is for you. Now, that's one route. The second route, if you wanted to kind of step in and just dip your toe, you can open an online brokerage account. And I think the proper vehicle, if you don't know anything, is not to start out with equities. It's better to start out with investing in something that I think is more of a pooled investment vehicle where you have a portfolio manager like me that manages that portfolio. So when you invest in a mutual fund, that's like kind of like that kind of a perfect vehicle for someone to step into. It's a pooled vehicle that you could own a collection of stocks and someone doing the buying and selling for you, and you don't have to put yourself through all the individual work of individual stocks. You can do the same thing with an ETF. So I think if someone wants to sort of step into the market, I think ETFs and mutual funds are kind of good ways to dip your toe as you learn a little bit more, and then kind of when you start studying a couple of companies, watching, news, you can sort of branch out to some stocks. In fact, you can look at the portfolio, look at the companies underlying your mutual funds and ETFs and figure out what's in those that you like. You can start there with a more limited list. A lot of people also start out with index funds. They just buy the S&P 500, or they buy the, any kind of index, and they kind of play that as a way to sort of dip your toe. All those approaches make sense, but I think going directly into buying the hot stock is kind of where I think a lot of people will fall victim to, not really knowing enough about what they're investing in.
Right. Okay. So yeah, because basically you said index funds, mutual funds. So since you pretty much threw those out there, can you explain the difference between mutual fund, index fund, and exchange traded fund?
Sure. So let's start first with the index fund. And an index fund can be in a form of a mutual fund or an ETF. But let's sort of describe first what an index fund is. So everyone's very familiar with the S&P 500, the NASDAQ, and the Dow Jones Industrial Index. You hear those quoted every day when you watch the news about what happened in the market. So basically, you can buy that index and get the return of that index. There are several products where you can purchase just that index, and every day the return that you see in the S&P 500, the NASDAQ, or the Dow Jones Industrial Index, that your portfolio is going to do exactly that. Now, there are multiple indices you can buy. Those are just the three most popular ones. But that's what an index fund is. It basically replicates the performance of a stock index. That's it. And that can be done in a mutual fund vehicle or an ETF vehicle. So now let's move on to what a mutual fund is. A mutual fund is a pooled investment vehicle. It's basically established under the 1940s Act, Securities Act. And so you're protected by the SEC, where it's a vehicle that you can invest in, where there's a portfolio manager that's in charge of it. There are rules about disclosures, prospectus, but ultimately, and also redemptions. There's a certain time frame for when, if you buy a mutual fund, there's also a time frame for when, if you wanted to redeem your mutual fund, you can get your money back. But it basically allows you to invest along with several other people in a portfolio of stocks that someone is managing on your behalf. They do all the buying and selling. It's a structured fund, and you can participate in that. And typically, it starts off with an initial investment. I mean, if you're doing like Charles Schwab or some of the other online brokerage platforms, $100 you could start, and then every month you could add another extra $10. But it's just a pooled investment vehicle. It trades only at the end of the day. Doesn't trade during the day. So if you look in your brokerage account and want to see the quote, you only see the quote at the end of the day, and it's going to be that's the one thing about a mutual fund. Now let's shift to an ETF. An ETF is kind of a bit of a hybrid. It's a pooled investment vehicle, but it trades exactly like a stock. But it's a pooled investment vehicle of a collection of companies that can look like an index fund, but you can buy and sell that and see the quotes. So you can have you can buy with an ETF. Like, for example, a good one, to give a good example, an ETF that I own personally is called JETS. It actually owns all of the airlines. So if I wanted to invest in the airline industry, it's an airline index, but they create an ETF out of it. I could buy that, and that has shares of Delta, Southwest, United, all of them. And I use that vehicle to play the airlines generally, instead of buying just one, instead of buying Southwest.
Get out of here.
Oh yeah.
Wow.
Yeah. JETS, Jets. That's the, but what you're able to do with that, and which makes it unique is, again, it trades in the market like a stock, but it's a basket of securities there. And you can also bet against the ETF. You can actually sell it short. I don't know if we want to get into shorting, but it allows you to do a lot more like it's a stock. Whereas you can see the quotes every day. But I don't want to go too far down that level, but that's what an ETF is.
Okay.
Exchange traded fund. I don't know if I said ETF, but exchange.
Right. Okay. Yeah, I'm definitely gonna have to research that, because I like the sound of that, where you invest in just in everything. I like that. But let's shift gears a little bit. Talk about crypto. So are monetary cryptocurrencies like Bitcoin and Ethereum the future? What are your feedback on that?
No, that's a thoughtful question. So it's funny, and it's also timely. I don't know if you saw what's going on in the marketplace these days with Bitcoin Ethereum and Dogecoin or Dogecoin, whatever it's called. But those cryptocurrencies have been increasingly volatile. Like Bitcoin is now trading. At one point, it was at what 65,000. Now it's trading at 30. There's a lot more volatility. Now, why is that? There are three incidences, and I'm going to get to the answer to your question that I think are really affecting the volatility of these cryptocurrencies. I do think they'll be around in the future, but I think ultimately you're going to have something that gets that big where it's a medium of exchange. Government entities are going to want to have their piece to monitor transactions and also be able to tax the exchange of goods and services. And I think that's where we're going to get to. And so I think there'll be cryptocurrencies. Now let me talk about what happened over the course of the week. Make me say that. So we had the first thing was Elon Musk made some comments about Dogecoin, and he also told investors that they're no longer accepting Bitcoin as payment for Tesla cars. So that caused a bit of a collapse in Bitcoin. Number two, you probably heard about the ransomware attack on the pipeline. How did they pay those people that they were trying to pay them?
Right.
They paid them in crypto. Governments don't like that. Governments don't like that because you can't track who it goes to. If you had a more monetary system, you could kind of see where it's going or at least have a sense of it. Bitcoin, cryptocurrencies don't like to do that. And number three, related to the second one, China said they're cracking down on cryptocurrencies.
I saw that.
Yeah, so that's creating all this volatility. And now I think there's a future for it. But again, and I think the thing that's different from the bubble of Bitcoin that we saw back in 2018, I believe it was, is that you have real companies and real investors actively investing in this now as a store. Whereas in the past, it was much more speculative. Now the market's still growing, and when you don't have as many investors in it, that creates that volatility. But I do think there's a place for it, and I think we will see it. But I think you're going to see a lot more government intervention into trying to monitor and be able to tax transactions. So I would recommend if you're going to invest in things like that, make it a small portion of your portfolio. You can play it, but don't allow it to be a disproportionate portion of your portfolio. Kind of going back to my earlier point, that can kind of reach on your ability to sleep at night.
Okay, good deal. And so we have one question that was asked over in the comments. Jawan Jones, he asked, and that was a question. It's funny he asked that because that's something I have been wondering. Do you believe the federal government will introduce a coin that will this negatively impact the crypto space?
I think that that's a possibility that you see the government. I mean, I've heard Ben Powell on record make a few comments about cryptocurrencies. I'm not sure when or where, but I do think there's a potential for the need to kind of introduce something to compete with them that the government has more control over. I think there's a risk of that. But I think the appeal of cryptocurrencies is that it's not. Here's the thing about money, and this kind of goes back to inflation. Money is controlled by central banks, and the money supply is how they are able to influence or stimulate the economy. So when rates are low, there's more money that the Fed is allowing to flow through the economy and allow things to kind of speed up and get the economy moving. When the economy is overheating, you can take money out the system. You raise rates, and you can kind of control the flow. And so the cryptocurrencies allow you to circumvent that because the money supply, although for Bitcoin, it's algorithmic how the money supply is driven. It still doesn't give the government, if the government can't affect the spending rate or the velocity of money through monetary policy as well, because these cryptocurrencies they kind of have a little bit of a less power, and governments don't cede power. And so that's kind of where I think that question is kind of spot on, that they're going to want to find with it.
Gotcha. Okay, that makes sense. I definitely feel pretty much the same way you do. Because it's all over the place, and I really feel the government going to try to get their hands in it eventually. But something else for you. What is the best investment you've ever made, and at the same time the worst investment you've ever made?
Well, I'm trying to think the best one I've ever made. Okay, this one's a complete surprise. It wasn't anything about skill. There was a small industrial company that I own. God, what was it called? It's been so many years ago, but they produce like these chemical inputs that go into the chemical process of for in goods. The name is I'm struggling to the way. So you don't see this company, but you know their products. The products are used to like dye your Coca-Cola can red and to make the Tide. It's an important input process, but they also produce another chemical that makes things white, that like bleach. And so this company, I bought it on a cheap. It was a little dingy company that slowly but surely was gaining market share, and I bought it for like say maybe $10, right? It got taken out for 50 because of a bidding war.
Uh-huh.
And it, like a company came in and bought the company.
Whoa.
And so, I mean, and I had no idea that was going to happen, but that wound up being the best returns I've ever had.
Wow.
That's kind of a diamond in the rough, though. That does not happen. You can't. It's not repeatable. I mean, what you do to kind of encourage that is you buy good companies. You buy them out to what you think they're really worth, and good companies do get acquired. You just can't tell when that's going to happen. I just happened to call it right when it happened and got lucky and made a ton of money on the stock. First one was actually a fund I bought many years ago. It was an investment management fund. The investment team was based out of Denver, Colorado, and I had actually met with the portfolio manager and spoken to him and really got a good familiarity with the mutual fund. And so this is actually while I was at work. I was used to be in this world where I used to pick mutual fund to put into a portfolio, so to sort of manage our firm's sort of assets. So I put this fund in there. I pitched it to my investment committee about how great this fund is and how astute the risk management process was. They have a good way of protecting you on the downside. So, I put this thing in the fund. I mean, they invest a few million into this little sleeve that I put in for this. It was a mid-cap growth fund. About the first quarter comes around, and they have a whole portion of their portfolio blow up, and this thing collapses. I mean, the fund would underperform the benchmark by like 500 basis points, or 5%. So if the index was up 5%, they gave me a 0. Everybody, so it blew my. Does that make sense? If the index was up 5%, I got 0 out of it, right?
Right.
0.
Right.
That's bad. And
Yeah.
I had to automatically terminate that, and that was a big sort of loss. Think about that. You invested, 100 million, and you walk away with 95.
Right.
That was a tough day.
Wow.
But it happens.
Yeah. And and that's part of the market. You're not always going to, win. You're not always going to profit. But I mean, that goes back to the risk tolerance, But yeah, definitely. One question in here, I think you may have touched on it earlier. Mar Jones wants to know, how early should a person start investing in a Roth IRA and 401s?
As early as you can. This goes back to my earlier point. Remember this comment I made about compounding?
I thought you said something about that earlier. Yeah.
Yeah, compounding is your best friend. And next to having the money to invest is having the time to make it. And the longer your runway, the more time you can, one, put the money in and compound and allow it to grow. So if you have access to an IRA or a 401k, and you should be investing that now, because you're taking money from yourself now to give it to yourself later. And you want to give yourself as much time for that money to work for you. So I say, if you have it, do it as soon as you can. Heck, if I could have done it at age 20, I would have done it. I didn't have any money and I wasn't that smart, but as early as you can.
Good deal. Yeah, I thought you had touched base on that earlier. So what are some things that you see regarding our attitudes towards money and wealth that need to change in order to be more financially successful and obtain financial freedom?
I think the most important thing, and I see this in the industry, and I even suffer from this sometimes. Wealth happens one day at a time. The big win, the trend followers, the news items that you see, like stuff with the the meme stocks. That stuff comes and goes. You hear about the guys that made money, but for every guy that made all that money during that meme stock situation, there's countless others, multiples of them that lost. And so I think, kind of going back to the original question, it is really, really important to really be patient. Take your time, be thoughtful, be deliberate, and allow the portfolio to work over time. Be patient. I mean, and I'll tell you this: it's like a lot of guys do a lot of high frequency trading. Turning over their portfolio. When you do that, all you're doing is enriching the other side. By creating this turnover. But guys that can hold things for a long time and navigate the ups and downs of the marketplace you talked about, over time you come out very strong. In fact, if you're adding when the market is kind of collapsing and you're doing it selectively in companies that you have conviction in that are good businesses, that will ultimately reward you. And so that's the thing that I think the attitude towards wealth is it's a marathon, not a sprint. It requires patience. Patience is the virtue, and being thoughtful and not chasing the quick buck is the one thing that I think human nature, sometimes when you see somebody make a big win or you hear about it on TV, you just feel inclined to want to be a part of it. But I think the long game is how you really win this and how you really generate multi wealth. I think the last point is also just being aware of how to pass that wealth on. I think particularly in our community, for just speaking from the African American community perspective, wealth is wealth generation and handing off wealth has been a challenge. So I think financial planning, having a life insurance policy, building a trust. I mean, these are things that I'm still working on, but having those things in place. So for when you make a lot of money, how those assets get transferred to the next generation to avoid tax liabilities, to just planning. I think those things are critically important, and I think the attitudes toward it need to change because people need to be thinking about these things now and ingraining in their kids the wealth transfer. And I think other cultures have gotten really a head start in doing this, and I think speaking just amongst African Americans, I think we're getting there, but we could do more work, and I think that's an important thing that I would want to see more thoughtfulness about patience and also just how to transfer wealth to the next.
Right. Yeah. I love that. Yeah. Patience and how to transfer wealth. Yeah, that's big. That's big, because we definitely need to think about who we're leaving behind and how they're going to be taken care of, So I love that. And that's one of the big things that, my wife and we're on right now, trying to leave a legacy, So just trying to put money away and let it grow for now and be there for the kids. So, yeah, I love that. So what are some things that you could recommend to new investors as well as people that's already investing? Because one of the things that you talk about the meme stocks, a lot of people jumped on those stocks because Johnny down the block said, GameStop is jumping right now. You got to jump in. And a lot of people jumped in because of Little Johnny down the block, not realizing Little Johnny down the block bought it when it was $32. Now you're jumping in at $110, So what I've learned, we need to do research on our own, So what are some sources that you could recommend, like books or YouTube websites, anything of that nature? What would you recommend for people that try to do their own research?
Fantastic question. So let me start with the books. So I'm a value investor. I operate very much in that sort of Warren Buffett, Benjamin Graham. And so the book that I recommend anybody get is The Intelligent Investor. That is the quintessential value investor Bible. And if you want to go even more go into more detail, there's another one called Security Analysis, also written by Benjamin Graham, that again ultimately outlines the whole underlying philosophy of value investing. The other ones are names that you've heard before, probably Rich Dad, Poor Dad, that sort of teaches you wealth happens one day at a time. The Millionaire Next Door, another similar one. It kind of is a statement about, consumerism. I think that's the other thing. I mean, people tend to look at the guy that's spending the money that looks like he's doing all the things, but the guy that probably, is probably pretty modestly doing things is probably far more better off because he's not spending his money trying to tell everybody how wealthy he is. So Million X More, I think, really gets that. And then the other one is A Random Walk Down Wall Street. That's a really good one that I think talks about just how markets trade and, how, random walk is a mathematical concept about how sometimes the coincidence of returns are random, but it kind of gives you some sense of it. Some magazines. So those are books. Magazines. I love The Economist. I love Bloomberg Business Week. I love Fortune and Money Magazine. Those are very good resources just to get conversant in what's going on a weekly basis. And then newspapers. By far my favorite one, it's really a newspaper with a weekly newspaper, Barron's. I read Barron's religiously. Before I go to bed Sunday, I read it, and I kind of have a sense of what's going on in the marketplace. Barron's is fantastic. But on the daily newspaper front, the Financial Times, the Wall Street Journal, Investors Business Daily, I'd probably say those are the three primary media that you would utilize to kind of just get conversant in what's going on in the market on a daily basis. Websites. Okay, so if you're going to I use Charles Schwab for my own personal trading, but Fidelity they all have very good resources within their websites that allow you to kind of do your research on companies, give big picture what's going on in the economy, and provide outlook that allows you just eclectic views of what's going on. But let's say you wanted to sort of look at some other resources outside of your brokerage platform. Bloomberg is really good. CNBC website's really good. Google Finance actually is a good, decent way to kind of get your feet. It's like sticking your pinky toe in the water, but it's better than nothing, right?
Right.
Motley Fool is really good. And then the last one, Seeking Alpha. Seeking Alpha is a pretty good, it's a blog of chartered financial analysts that write reports on companies, but really good at just breaking down what's going on in the market. And if you wanted to get some individual insight on a company that you're interested in, you can usually find a research report that somebody wrote. That basically a guy that just wants to publish a report on a company that's pretty well thought out and robust. So those are all the resources that I, would, say, things you can look at to kind of get more information on what's going on.
Good deal. I wrote down almost every one of them that you said. So, yeah, thank you so much for that information. I'm definitely going to use all those tools. I need all the information I can get. We have Brother Holmes here. He says, what about stocks that are trading on foreign markets? Are there any limitations on Americans investing in foreign markets?
So you can kind of get it through two forms of media. That's actually a good question. So if there's a company that's trading in the U.S. on the U.S. exchanges, you can buy that, and there's no limitations. That's a company that would be having like American depository receipts, or you can buy a mutual fund that buys those stocks directly, and that's an easy way to do it. You can buy an ETF that invests in sort of foreign stocks. So those are three easy ways to do it. If you want to invest directly in an emerging market, that's harder. You typically do that through funds, but if you want to invest like in the London Stock Exchange or some of the developed markets, that's actually not so hard to do. You can do that through your brokerage platform if you have any of the major brokerage houses. But I would propose that if you're it requires you to do a lot more research, and probably the biggest companies are going to be the easiest ones to invest in. That's not so hard. But if you want to invest in some of these more emerging markets where the markets are not as efficient and sophisticated, I would propose you go through a mutual fund or something to kind of sort of mitigate the risk of kind of trying to get through and understand reading reports that might be in different languages with different accounting rules. I would see that. I would propose you see that to a portfolio manager that can sort of help you get through that process. But there should be no limitations as long as it's listed on a major exchange.
Okay. Good deal. Mm-hmm. Yeah. So very, very great info. Great info. Is there anything you think we left off that you may want to kind of chime in on? Because I think pretty much every question that I had, you kind of answered that and some more. So yeah, anything else you think that you would like to share with us?
One question. One thing I think is worth pointing out. We talked about the market-oriented investments. There's also non-market-oriented investments. Probably the easiest one that everybody can get their hands on and can act on is real estate. And just a few comments about real estate. Real estate is typically an excellent hedge against inflation. Housing prices kind of go up with the inflation rate, and so that insulates you. Obviously, it's not risk-free. Everybody who lived through the financial crisis of 2008 is now well aware that home prices can go down and can go down in drastic fashion. And you also know that the mortgage market can go through periods of over underwriting, and so that causes prices to kind of have to settle out at some point. But real estate is a very good place to also think about as a portion of your portfolio that is not as correlated with the markets. And if you are a real estate investor, you don't have to be own a house to do that. You can also invest in real estate investment trusts or real estate funds that trade on the market. You can get that exposure that way too. But I would say think about your portfolio in a wholesome context, not just stocks and bonds, but also real estate and other investment vehicles. Maybe you want to put your money in some money markets. Just think about it as a full suite of options for you outside of just stocks and bonds, because that's kind of how your financial advisor is going to look at it.
Good deal. Good deal. Wow. That's good. That's good. I had a question here from Cynthia. She says, although her Doge is going down, should she keep purchasing or wait? Once again, this is not financial advice that we're giving. Me personally, for myself, anything that I'm investing in, if it goes down, me personally, I buy more. I don't know if you would feel the same way, Derik, but me personally, that's what I've been doing. What are your thoughts with that?
Yeah, so generally, if you have a lot of conviction in something and you believe it to be the market selling off is overly punitive, you typically would take the advantage to buy it at a discount to that price and dollar cost average and get a bigger weight at a cheaper price and increase your upside opportunity. So that's generally what you're saying. I agree with that in principle. And with respect to just the cryptocurrencies, I won't speak specifically to Dogecoin, but I'll speak to just the bigger picture of the volatility is something that's going to be a continuous thing, I think, in this space. So if you're going to invest more, be prepared for just that wild ride. It's going to continue. Again, we talked about all the exogenous forces that cause that volatility. Chinese government, people asking for ransom in coins, Tesla with, Elon Musk saying things that create more investor consternation. But the one thing I will tell you with the IPO of Coinbase, and there's a few other exchanges that are coming out, that does create a better medium to go and buy and sell these coins that eventually, when it gets widely adopted enough, you'll see some more balance to the market. But I think the last point to make about these cryptocurrency markets and any kind of foreign currency market is these markets don't close. They're open all night. So no matter what happens in your market when you go to bed at night, some news could happen while you're asleep that creates more volatility. So just understand those things. When you invest in cryptocurrencies, those markets don't close. But I think you can probably expect a little bit more volatility there just because of all the stuff going on. And that's kind of what you're seeing right now.
Right. Yeah. Okay. Good deal. Does anyone else have any questions? If so, feel free to type them in that comment section before we wrap up. Anyone else have any questions for Mr. Coffey? All right. Well, I don't like quiet time. So I would start singing, but everybody may log off. So yeah, one quick thing here while we're waiting to see if anybody plug any questions. Remember, social media, chime in with me during the week on my social media platforms. Instagram is _Eric Winfield. You can also follow our group page, LifeStruction with Eric, as well as YouTube. For those of you that know people that don't have Facebook, we definitely be streaming live on YouTube every week as well. Also, if you haven't got it, remember you can get this book here, this great book, by me, LifeStruction. You can get it on my website. So definitely, if you haven't gotten that, definitely go to the website and grab my book. Also, for those of you that may be chiming in for the first time, we do have a little thing that we're doing where we're trying to purchase books to go around to little halfway houses and facilities and distribute my book to people that's trying to rebuild their lives. So we have a book campaign going for that. So feel free to go to my website and drop a donation on that as well. No donation is too small. Also, T-shirts. We will have that up tomorrow on the website. So if you'd like to get one of those, My Life is Under Construction tees, they will be on the website and ready for purchase tomorrow. Other than that, I think that is about it on my end. I'm looking in here to see. You must know this guy. Is it Cicero Holmes?
Yes, I know who that is.
Yes. He said, "Do you regret not betting on the Knicks' future?"
We'll talk about that. That's a bad investment. That was a bad investment. A bad not done investment.
Yeah. Well, I mean, I can't say anything. I've been Philadelphia 76ers all my life. So I mean, hey. But when you die hard, right?
Well, I got love for Philly. I mean, one of the greatest Sixers is actually from our hometown, Kevin and I, Julius Erving.
Uh-huh. Yeah. Okay. Good deal. So yeah, we don't have any questions over here. So if that's it, we're going to wrap it up. We thank you so much, Derik, for taking time out of your Sunday to come on and give us this great information. I definitely, I checked out your LinkedIn and I was like, this brother has done some of everything. I mean, long portfolio, but everything you said was definitely valuable. I did not take your time for granted. I have like 3 pages over here full of notes. So I definitely have my work cut out for me. I'm definitely going to be doing my research. Not sure if my sister was supposed to be on. I'm not sure if she's on or not. But if so, I'm sure she got a bunch of great info as well. But yeah, a few comments in here saying great info. Thanks. A lot of people thank you for your time. They enjoyed you. So I thank you, brother, for coming on. And hopefully we can chop it up again in the future sometimes.
I would love to.
Definitely. Thank you so much.
Thank you.
And yeah, you have a great Sunday. And yeah, we'll talk soon.
We will. Thank you so much. And thank you for having me. I enjoyed it.
No problem. And to everyone that's on, you have a great Sunday. The rest of your Sunday, have a great week. And remember to keep smiling from your heart. That smile from your heart will create a glow that'll bless someone else's day. So with that, you guys be blessed and have a good one.